right. Good Monday morning and welcome back, investors and traders. It's felt like a long weekend for myself, at least, as I've been in travels and doing a lot of work. To our Finom group members, thank you for your patience and consideration as we were not able to deliver a weekend research report this weekend, but I thought this would prove a timely video with some relevant quantitative data and, as usual, some pertinent insights, given that the markets have seemingly paused and are at least consolidating in price, although it seems insignificant at this point. So is this a pause consolidation period that refreshes the bull market? Remains to be seen. I'm of the opinion that that will prove the outcome, but for now, it's an open-ended question. One of the things that we're looking at, and I think would be a good exercise for all investors, is to take note of what we have here so far as the moving averages all being or forming a curling, rising pattern. Oftentimes, investors will, especially during pullback phases, they're looking for the different levels of support, and whether it's Fibonacci retracement levels or key moving averages, many investors will use this form of technical analysis to provide them with beneficial opportunities to buy the pullback or buy the consolidation phase. Something that I've recently talked about with Finom Group members in our private trading room during the course of the trading week, kind of outlined right here. Strong bull markets with breadth thrust, and we've definitely had breadth thrust, but strong bull markets with breadth thrust and overheated or overbought conditions rarely offer meaningful pullbacks. I know everybody's waiting for some kind, a 5 to 10% pullback or correction. But in order to get that, generally you have to have even worse market internals than many have proclaimed over the last couple of months. I mean, you don't get overheated, overbought conditions with breadth thrust if you don't have broad-based market participation, and that's what we've seen. So plan accordingly. If you have layered out on the way up, meaning that you've taken some profits as the market has trended up some 14%, the S&P 500, 30% in the NASDAQ, you might want to focus on layering back in during consolidation periods instead of solely relying on support levels that are rarely achieved given the aforementioned market conditions. And again, those market conditions being breadth thrust, overheated and overbought conditions. I mean, rarely do you get perfect consolidation phases, that, can, where moving averages can prove support. But nonetheless, from a, well-rounded technical analysis perspective, it is, somewhat relevant to identify those moving averages which might prove support levels. And the first one that we have may come in is the 20-day moving average. You can see it right there, 4303 is that 20-day, the fastest moving average that we will look at for potential support. Then will come the 50-day moving average down there at 4202. Below that, the 100-day moving average, and way down here is the 200-day, the slowest moving average. One thing to note, and we've watched this. If you're looking for signs of a new bull market, historically you want to see that 200-day, the long-term moving average. You want to see that flatten out and eventually curl higher, just like the other faster moving averages. And here we did see a bottom, it looks like, on March 28th, 2023, we saw a complete bottom here in the 200-day moving average at 39.51. We had the flattening out of the moving average down here, or this time frame back in February, but the ultimate bottom was right here on 328 at 39.51. And ever since then, we can see it is higher by about, got up to about 1% higher than its low point. And then that is a critical understanding of how to define bull markets. So we have this study here to go into greater depth with respect to the 200-day moving average rising 1% or greater above its trough level from Bespoke Investment Group. And here's what they say or offer. The 200-day moving average on March 28th hit 39.51, its lowest level in more than a year. But since then, it's risen just over 1% above that low. Like a cruise ship, the 200-day moving average doesn't just turn on a dime. So when it starts to shift directions, it's usually a reflection of the fact that the market's longer-term trend has shifted. And so here's the table that they offer. Past cycles where the S&P 500 200-day moving average rallies 1% off of a 52-week low. Most importantly, I always go to the percent positive forward performance in the S&P 500. And the percent 1 month later, 75 times. 75% of the time the market is higher. 1 month later. 3 months later, same positivity rate. 6 months later, 85% positivity rate. 1 year later, the market has never delivered a negative return after the 200-day moving average rallies 1% or greater. Again, looking for signs, looking for validation that this is a new bull market. Well, there you go. All right. So what Bespoke also goes on to say is that should bode well for the stock markets that's facing a few challenges, including a potential recession and potentially more rate hikes by the Federal Reserve. The 200-day moving average has a slow-moving nature. Because of that, the reading has resulted in just 20 periods running back to the late 1920s when the technical indicator made a 52-week low and then rallied more than 1% off that low within the next 3 months. But history shows that 1 year later, S&P 500's average gain, 18%. The median gain, 14.4%, folks. And again, 1 year later, the market has never been negative. The same thing has also happened to the NASDAQ, folks. NASDAQ 200-day moving average rallies 1% from 52-week lows. History doesn't always repeat, Bespoke says, but periods where the 200-day moving average rallied 1% or more from a 52-week low usually indicated that the low for the broader market was in. And there you have it. This is the latest signal also from the sentiment trader, right? Because just a couple weeks ago, as we declared for our Finom group members in our weekend research report, and as usual, if you don't subscribe to our weekend research report, fully encourage doing so. It comes out Sundays. You can do so. Their starter membership at $14.99. You'll receive our weekend macro market research report, all of our quants, all of our technicals, all of our fundamental analysis, alongside our weekly state of the market video that comes out Thursdays. And as usual, if you want to trade with us and get our weekly, daily trade alerts, as well as our long-term investment ideas, you can become a premium member for $59.99. All right, so the latest signal from the sentiment trader with respect to the S&P 500 achieving a new all-time high in the advanced decline line, right? Again, narrow breath. How you get narrow breath? When you see the advanced decline line for the S&P 500 making all-time highs. And what they go on to say is this study, essentially, this is the bottom, this is the advanced decline line making a new all-time high. And as the saying goes, or most technicians proclaim, is that breadth leads price. If the S&P 500 advanced decline line is making an all-time high, we are likely to see an all-time high at the index level itself in the not too distant future. The advanced decline line at an all-time high, the annualized return 18.8%. AD line not at an all-time high, annualized return only 7%. Market was up at the highs this year, 14%. Keep that in mind, folks. Again, for the whole, narrow market breadth crowd, this is a chart from Ed Yardeni, of Yardeni Research, Dr. Ed Yardeni, if you will. Percent of S&P 500 companies with positive year-over-year price change, meaning they're up on the year, hit 70% just a couple of weeks ago, 72% just a couple of weeks ago. We see all the headlines regarding, well, the S&P 500 return, some 99% of it is the top 10 stocks. And only 1% of it is coming from, that bottom quartile. But the reality is, they're not up as much as the top 10 stocks, but they're still advancing on a year-over-year basis. 72+% of stocks had been up as of 6/16 on the year. Most stocks are higher. And again, that just validates what we're seeing with the S&P 500 advanced decline line, making a new all-time high. People just love to complain. The financial media does a really good job of hyperbolizing the data. You got to be careful, where you get your information. And as usual, you want to be informed. You don't want to be scared. This is pretty awesome from Walter Deemer in one of his books. When the time comes to buy, you won't want to, right? Because things are generally, pretty scary when stocks are on sale, right? And we get all these headlines from the financial media. We get all these negative warning alarm bells that go off from the likes of CNBC, Fox Business News, Bloomberg, Yahoo Finance, and such. But one of the things that Walter Deemer says in his book is, if you want to watch CNBC like the pros do, turn off the sound. Most trading rooms, they will run CNBC in the background. They'll listen for different commentary, play the video clips and what have you. We do the same thing at Finom Group during the course of the session. Why? Because we want to stay informed. We want to achieve the information flow, but we don't want to be afraid of it. And there are key things to understand when it comes to information flow and the financial media. You want to be informed, not afraid. If you find yourself being afraid, it's impossible to be informed. All right. And remember, this is scheduled programming that you have on these financial media and news networks. Rarely is it going to answer all your questions, right? You get a segment here, a segment there about this topic, that subject matter, and the like. They're not going to be complete. You won't be completely informed. And without complete information, there's a degree of misinformation. You're not able to inject and get the answers. So be careful when it comes to the financial media. And one of the hot topics this year is, oh my gosh, look at FanMag. Look at the top 7 or mega cap 8 stocks, up 87.7% year to date. If you take the average return of Meta, Amazon, Apple, Microsoft, Tesla, NVIDIA, and Google, right? And the average stock, let's see, if we look at the equal weight S&P 500, that is up only 3.5% year to date. It's up year to date, though. Keep that in mind. So everybody's complaining because the market, is top heavy, right? And they lead you to believe that's some scary thing. But that's how market cap-weighted indexes work, folks. I didn't hear anybody crying last year for the FanMag cohort of stocks when they were down cumulatively 46%. Right? I mean, all of a sudden, this was bad. This was not bad. This was nothing to hyperbolize, but this is. It's the hypocrisy of the financial media, right? Alarm bells go off when it's this good. This is par for the course when it's this bad. I'm sorry, folks. That's called bias. Anyways, a couple of data points I did want to reiterate. Seeing how we're about to cross the halfway point of the year, recall the very beginning of the year, the January trifecta indicator fired. And that happens when the first 5 days of the trading year, the first 5 days are positive. You get a positive Santa Claus rally, and the month of January finishes with a positive return. For the rest of the year, how does the market perform the rest of the year? Well, 13 times since 1949, we've had the January trifecta complete. 13 times. The full year was never down. Up all 13 times, down 0 times. You look at the average return when you get the January trifecta signal, 22%. I'm not saying you're going to get the average return. Maybe we'll look at the worst return. And the worst return looks like 12% in 1978, followed by 13% in 2011. All righty. Oh, wait, no, is that too many? Yeah. Oh, New Year 2012. Sorry, the New Year 2012. And this also, the other criterion for the January trifecta for this particular set of data is that the prior year, the market did have a bear market. All right. NASDAQ 100 index had a new 52-week high after more than 6 months without one. Talked about this last month. On 5/18, the NASDAQ 100 made a 52-week high. 1 month later, index is up 78% of the time. 3 months later, it's up 85%. 6 months later, up 85% of the time. 12 months later, the market has never been down, or I should say the NASDAQ index has never been down. NASDAQ is expressed, so far when you look at the large cap indices, the NASDAQ 100 and NASDAQ have expressed the largest pullback during this, maybe immature consolidation phase. Again, looking for bull market signals, new bull market signals. This is yet another one. The market has never been down. The NASDAQ has never been down a year after it's made a 52-week high. I think this is last but not least. And again, I hope everybody has a great trading week here to kick off Monday. This is from Fundstrat's Tom Lee, looking at years where through the first half of the year, or through, from the first calendar day of a new year through the end of January, which will mark the end of the Q2 period. And by the way, we are on the cusp of also achieving, Q2 earnings results in a couple of weeks here. But when you are up greater than 10% through the first half of the year, the full year return has always been positive. 100% of the time, the S&P 500 has been positive when it has been up 10% or greater through the first half of the year. Look at the average returns. Look at the median returns, folks. The other thing to notice here is that, let's see, 1, 2, 3, 4, 5. 5 of these particular calendar years were year 3 of a 4-year presidential cycle. What is 2023? It's year 3 of a full 4-year presidential cycle. Now, if we just achieve 12% from the closing low, from the close on last Friday's close, just a heads up, we're going to achieve all-time highs here this year. It is very much aligned with the data. All of the data that we see very much says the cyclical nature of this new bull market will propel the S&P 500 to new all-time highs either this year or into 2024. JP Morgan, latest bull market, 5 signs things could be getting better. And here's also something they see. And the reason why I bring this up is because 2 of JP Morgan's best known, and some may say their best analysts and strategists, have come out suggesting that the market is going to go down from here. The back half of the year is going to get very bad. But JP Morgan's wealth management division says stocks are the long-term growth engines of investment portfolios. And with the lows, in our view, behind us, we think investors should consider rebuilding their equity portfolios now for the next bull markets. They give 5 signs, and this report will go out to our Finom group members, but they give 5 signs things could be getting better. Again, we'll disseminate that to our Finom group members. At this point, we are on better footing from both a growth and inflation perspective versus where we started the year. After rallying 22% from the lows, S&P 500 is now just 8% away from all-time highs. We know bad stuff happens, risks remain, and sell-offs can happen during times of transition. But whether you call it a recession or a slowdown, we see opportunity. In the 10 other instances since 1950 that the S&P 500 has been up 15% or more in the first half of the year, it's gone on to make further gains in the second half, 6 of those times with the full year return on average 25%. Some good data here to start off your week first, folks. And again, some good words of wisdom from our friend Walter Deemer. That being said, have a great trading week. Don't forget, subscribe to Finom Group, and we'll see you on the next video.